Still today, central markets for electricity play a crucial role to balance our power system between power generation and demand in the short term and providing price signals for investments and risk management in the long term. This commercial model in electricity markets was rolled out 25 years ago when liberalization of power markets took place. It is still based on the physical design of a one-directional electricity market. Generators sell to the wholesale market, retailers buy power from wholesale markets and supply it to their decentral customers. For years, however, our energy system has been in a radical transformation towards decentralization, decarbonization and digitalization. While we already experience significant growth of renewables in the past 20 years, this growth will exponentially accelerate across Europe in the next 20 years to meet the need for decarbonization. Digitalization allows for radically different interactions on the electricity market. Decentral production can meet local consumption without involving central market players. So what does all this mean for the traditional commercial model in our electricity industry? Are we heading towards an end of central energy markets?
Could there be a better timing to discuss that question amidst the record-breaking power and gas prices in these days? But today we want to look a bit further into the future. We want to talk about the future design of electricity markets, which are today very centrally organized, because of the disruptions of a more digital and a more decentral energy landscape in future, but also because we are on a rapid path to decarbonization, and we will see far more renewable assets being to be integrated into the energy market of the future. I'm Axel Gerhardi, and I'm in charge of commodity sourcing and risk management at E.ON. And I have a great panel today here to discuss those questions. Let me briefly introduce them. So firstly, Alena Kühne from Ørsted. Alena is in charge of PPAs and of merchant products in one of Europe's leading wind farm developers and investor. So great to have you here. Next, Ewald Hesse. Ewald is CEO and co-founder of Grid Singularity, a software company which is extremely active in organizing, developing decentral energy markets and connecting them. And finally, Tobias Paulun. Tobias is board member and chief strategy officer of EEX, the European Energy Exchange in Leipzig. And of course, very active also thinking through how the market design of electricity markets can look in future. So great to have you all here. And let me try to start that session off with a question, Alena, to you on the development of renewable electricity productions like wind farms. So for you as Ørsted, how do you look at the future design requirements of electricity markets to feel comfortable to put so much money into the grounds for new wind farms?
Thanks, Axel, and thank you for having me here today. Where we focus, as Axel mentioned, is in the renewable development, and we have a number of large offshore wind farms that we are developing in Germany, but all across Europe as well. And we have actually had the first merchant wind farm that we've been developing actually in Germany. And that has presented a new challenge for us. In the past, a lot of our development has been through subsidies, and that has supported the sort of long-term investment plans that we have. But going forwards, with now being open to the actual power markets, we have to look for alternative routes to get that long-term certainty that we need as investors in renewable generation. When we look at the lifetime of some of our wind farms now approaching 25 to 30 years or more in the future, we need to have that longer-term certainty that unfortunately today, with the volatility that we see in the power markets, we can't get that alone from the central energy markets. And one of the routes that we've been pursuing is to sign long-term corporate PPAs. And that provides us with a foundation to give us the certainty on some of the revenues coming to the projects over the years before we build and take the investment decisions on some of these very large projects. We have seen a growing demand from the corporates themselves to take quite long-term commitments, typically 10 to 15 years, but we have seen some going beyond that with the recent demand in the market for achieving their long-term sustainability goals. Now that gives us quite a bit of certainty, but as I said, there is still a role for the central energy markets. We still need the physical balancing of our wind farms into the market and balancing the supply demand that you see. And that will become a bigger challenge as more renewables enter the market. And therefore, we do see within that short term a very key role for the energy markets and energy traders to play. In addition, as we develop and more renewable generation comes, it will not only be corporates that can support the long-term certainty, and there will need to be an element of more midterm trading in the markets to provide some of that certainty to the business cases. And then you start to see a combination of different risk mitigation options coming into the business cases for offshore wind or onshore wind or solar in the European markets as we move forward.
Okay, thank you, Alena. Tobias, looking at EEX role, how do exchanges support the further development of renewable assets?
Absolutely, and thanks for having me as well. And let me first pick up briefly on the title of today's panel and the question on whether we are heading towards an end of central energy markets here. That's absolutely not how we see it. I mean, if we look at what's happening in the markets currently, it couldn't be further from reality, I'd even say. I'd say that we are just starting to head into a new era of power trading. Looking back at the last years, the power markets have never been stable and constant or static, to put it that way. They have always undergone a dynamic transformation and even innovation. In the day-ahead markets, we have seen a coupling of market areas all across Europe. In the long-term derivatives markets, we have seen lots of product innovation, and I will come back to that in a minute. And then, last but not least, we've seen a steady increase of trading activity on the intraday markets, and I do not see an end to this trend. So what all of this brings is that the power markets in Europe have really reached the next level of maturity. And this stimulates new players to enter this markets. For example, we're seeing option traders from other commodity markets getting into the power markets and providing additional liquidity and also competition for the existing players. And as we speak, we also see a growing interest of global commodity investors. Now, just think about where we were 20 years ago. I mean, who would have said that European power is a global commodity asset in which large investors are looking to invest their money via standardized contracts. So which role do the exchanges play in this? I mean, just last week, EEX has started a new offering which allows the clearing of standard contracts 10 years out into the future. That's just one example for the product innovation that we have seen over the last years, and it fits perfectly to the demand of PPA players and power purchase agreements. These PPA contracts are an important tool for financing renewable investments, but they still leave the two counterparts with some market price risk and, even more important, with the default counterparty risk. So with this new offering of the exchanges, it's possible to clear these contracts and to completely eliminate the counterparty risk in there. So it's just one example. And then at the other end of the curve, the intraday markets, we're also seeing constant innovation with the emergence of decentral markets. All that together is really a holistic picture which brings us into a new or enhanced market design. The core pillars of the market, like providing transparency and competition, they still function well as they did years before. But with the current price levels and the volatility that comes with it, we see that risk management tools and liquidity to get rid of the positions you want to hedge is becoming even more important. And exchanges are the central players together with the clearing houses that can attract players also from other markets. So I really see us heading into a new era, very much driven, of course, by the renewable players and their demand.
Tobias, thank you. Very, very optimistic tone. But for a company like E.ON, I mean, will we find in 5 years from now, if power plants of kind of reliable, carbon-based, nuclear-based fuel sort are more and more out, will we find hedge partners for our customer demands? Will we be able to buy 2, 3, 4 years out into the future our commodity needs?
Absolutely, you certainly will. We see growing liquidity at both ends of the curve. And in the short-term markets, I mentioned the growth of intraday, and we also see steady increase in the longer term. And in between, there is a focus on trading and hedging activity in the next 12 months or the upcoming calendar year. Of course, with the growth of renewables, the hedging demand changes slightly. You need to take the weather forecasts and even climate conditions into account. But all across the curve, we see growth of trading volumes also because of the emergence of new players. So I'm fully optimistic that you will find these hedge partners in the market. It will certainly also require some evolvement of new players like aggregators, intermediaries, who we haven't seen so much there in the first days of the power market. But it's starting now. Some of the direct marketers, for example, are moving into that role. So the market is constantly adapting. The demand for hedging is there. The power markets have always been an attractive environment for long-term investments, and the market venues do provide the tools that the players need for that.
Very good. Yeah, let me use the opportunity to ask one more question to Alena before we move on. Alena, the rapid growth of renewables, which is foreseen, a doubling of capacity, let's say in the next 10 years in Germany standalone, maybe a tripling in the next 15 years. It's massive. And it will also be massive kind of parallel operations of wind farms. So there is this kind of famous word of cannibalization of renewables if they are all producing at the same moment of time. Aren't you afraid at Ørsted that this might happen and might ruin your business case in an energy-only market?
I think what we start to look at now, and in many other companies similar position to ourselves, is the system integration of renewables going forward. So there are many reviews are looking into storage, but also how you actually optimize the running of renewable generation. And there's a lot that can be done, and that's where I do see a sort of new role coming in. When you do have this complexity of, I said, some days where there will be too much wind, some days when not enough, and that's where the balancing of the system really comes into how we look at our business cases in the future. And that will bring new types of storage that will need to be considered, different technologies entering both on an overall central side, but also decentralized, where you have local to the wind farms and the generation itself, which does create different challenges in terms of managing the grid to handle that. And something we do start to look at as well is cross-country. So when you look at more of a pan-European approach, where from one day to the other, you may have different generation taking effect in the different markets, and how we can start to work with governments and also with energy players in those different markets to create a more balanced system. That means we can reach a stage where we are running mainly off renewable generation in the future and towards our own goal of 100% renewable generation. But with that growth needs to be the support and the development of the system alongside. Otherwise, as you mentioned, Axel, that there will be challenges to keep that all in balance at the right times.
Yeah. By the way, an invite to our audience. We will have a couple of minutes at the end of the session to also answer your questions. So please bring them up in the chat. Now moving on, I mean, the massive growth of renewables is one disruption of the market design. The other one is very much about the decentralization and digitization of our energy industry. And we heard a lot about this already this morning, and we will hear more in the next days to come. But Ewald, it's a good opportunity to bring you in here. How do you see technology disrupting the market design?
I mean, we can draw a lot of parallels from what's happening in the crypto markets in the last 4 years. And And the main drivers here is the demand for market access, choice, and new business models. So what we have seen only in the last 2 years is that the trading volumes have been, there is 20% of the trading volume in the last 2 years have been taken by decentralized markets, which offer market access because there is basically no entry barrier. Choice because because there is no entry barrier, there is much more innovators going into the space and building on those markets and extending those markets. And the other one is new business models. For example, in decentralized markets, there is a very attractive business model for liquidity providers to provide liquidity on trading pairs and so forth. And that is, that gives a very interesting yield. And that is driving massively kind of the bleeding edge innovation in financial markets. So we see this analogy also coming also into energy market at a later stage, of course. And we at Grid Singularity, we're investigating in this. We're building such markets for the energy market. So we have built a simulation environment where we can test it because, it heavily depends on regulation as well. But we think that this development is inevitable, and therefore, we need to build those solutions right now. And what is the best then to start with a simulation environment? And we have over 1,500 users actually already using these platforms, mostly by energy cooperatives, which are in a massive uprise, which are interested to have this degrees of freedom that they can use locally. And another change that we see coming is also actually a cultural change that is, that accompanies actually these decentralized market development, which is, people, they're interested in open source. They're interested to share. It's, the my culture, patent culture is completely changing. And that is a massive driver. All this together in the package, this will come to energy market, and we're heavily pumping for it.
Very good. Tobias, how do you see from EEX perspective the developments described by Ed? I mean, it sounds for me like democratization of the energy industry is kind of around the corner. How does this fit to the design of central markets?
Yeah, I think it's true. The technology will play a key role also in driving new roles into the market. The current central model, in particular, in the day-ahead power spot markets, has been designed at a time where much of this technology that we have available today was not available yet. And that was at the time where we defined it as a target model to have one central algorithm that calculates power prices all over Europe. Now, thinking about it with today's technology, that seems indeed a bit overcome, because much of this know-how and computational power that we have in the central algorithms is available on each trader's desk almost. So if we would design a target model today, I think it would be much more decentral and much more based on competition than the model we designed 20 years ago. That's in the end an opportunity for all. It should also drive the competition between the trading venues themselves, because different small deviations of market prices across market areas, for example, that can be arbitraged out by each and every trader with the technology available. So it's a great opportunity, and it also will give new ways of market access. If small players, even retail customers, do not want to become an exchange member themselves, they can use these intermediaries who provide market access electronically in an automated manner. That will be a key prerequisite for the even more decentral and local markets to emerge.
Yeah. So, Ed, if you then think about your kind of vision of an electricity market design, what is then the place remaining for central energy markets like an exchange?
I don't really think there is an either or. I think it will be symbiosis, because at the end it's a different client base. The central markets, they serve very large clients with very different needs than small trading assets or small trading consumers. And we see exactly the same in the crypto markets right now. So there is a lot of cooperation between the large exchange operators, centralized exchange operators, which very often provide liquidity on the decentralized exchanges, and even sometimes operate their own decentralized exchanges to serve for specific needs. So I rather see a symbiosis, and it's a natural progression. I completely agree with my colleague on the panel from AX that at the beginning, when the market design was designed, that there was no necessity for this, what we are working on. But now, as complexity is rising exponentially, and there is more and more assets entering into the field, wanting to trade because it brings yield. This complexity, I doubt, can be taken by a central algorithm. We had a lot of interventions with ministries of energy in different countries, where they did a lot of simulations, trying to optimize from a top-down perspective, and we have balanced this with a bottom-up agent-based market, where the regulation is embedded in the exchanges, and you can see, that the only way of scaling a lot of complexity is actually an agent-based system. But anyways, as I said before, there needs to be a symbiosis, because there still needs to be somebody who gives an overview of the total price, who provides liquidity on large products.
Yeah. You already touched upon the different roles we then see or will see in future being active in electricity markets, and maybe Alena, coming back to you. So how do you see that changing? I mean, whom do we need as a new player, or partly replacing existing players in the functioning of future energy markets?
Yeah, we see a range of new players actually coming into the market, and one of the ones that I deal with every day are the corporates. And a few years ago, we were on our first track of doing corporate PPAs from offshore wind, and we saw it as a fairly small market, a few companies trying to meet their sustainability goals. But as across Europe, that has changed, and we now see a high demand from a range of different corporates, not just the big tech players, but also a number of industrial players, trying to make sure they get access to the right type of green energy, and on a longer term basis, trying to protect themselves also from some of the price volatility that they see in the markets. And we see them playing a bigger role going forward in terms of actually driving forward more new renewable generation projects. And you've seen a few big companies in Germany making statements recently to the local government to make sure they can get access to the renewables when they need them. And that is helping drive forward the new projects. But with that, there will be different types of terms, different risks in those type of agreements that still need managing. And another player that we see coming in and having a big impact on the markets is the hydrogen growth in Europe. We have a number of different projects ourselves, so we are looking to develop green hydrogen, but partners within that have different drivers, looking across different markets, and that will drive a different demand profile needed from the renewable generation. A lot of the electrolyzers want to run as high a load factor as possible. We have a number of corporates as well looking to try and reach a sort of 24/7 target, and the growth of that will introduce then more stringent requirements on the actual delivery of the power every hour of the day, and measurement and tracking of that power, which I think starts to introduce, as I mentioned, a number of other risks that need to be managed, and also different profiles that need to be managed in the market. And so there becomes a new role and a new position for someone to start actively managing those risks and optimizing within different countries, within different markets, but also across markets. And that is definitely where you'd expect to see a few new players coming about. Of course, the existing trading houses can do that, but I think they will start to have to adjust how they trade today and take on that role. And also the exchanges as well, as Tobias mentioned, some new products coming in, new ways of tackling those risks.
Yeah, I mean, risk management is a very important feature here. Do you see new players coming? Who could be that kind of filling the gap risk manager?
As I mentioned, I said some of the vertically integrated players are doing that, have the capability to do that today. We ourselves have a trading house that are very linked to the generation side, but it's having that understanding between the off-taker and the generators to really get the best balance of optimizing some of those products. And there are some smaller companies coming in that have innovative products to manage the risk. I'd say it's amongst the existing players, but they will have to adapt to be able to take on these different types of risks.
Okay, Ed, same question to you. I mean, which new players, which new roles do you expect to come to the market? What is needed now?
What is needed now? I mean, what is the client taking, right? And that's the question that's driving us. And as I said before, it's more choice, market access, and new business models. And the main kind of new entrants. I've been in energy markets for 20 years now, and I've spent 12 years of my career on the vendor side. So we build power plants at that companies and so forth, and these is the new entrants I see. So more and more home automation companies and generally vendors are looking how to access markets. The most prominent example known to everyone is Tesla with the auto bidder, and as market access is becoming easier and easier, there will be more and more of these, and of course they look for new opportunities how they can provide more choice, convenience to the final consumers, or bring them more yield. And so all the new utilities or all the new kind of people entering into kind of, competing to E.ON's retail arm is like all the vendors that we see coming up there. And besides that, there is some kind of hidden new roles which are kind of more in the back end of the companies, which is an armada of data scientists, and so we have seen an overwhelming demand from data scientists in our simulation environment to test and train algorithms, providing those choices that the aggregators are looking for.
Okay, then. Tobias, back to you. How do you then see the energy transition impacting the central market design? I mean, what's then going to happen here?
Yeah, first of all, I fully agree with Ed here. I think the central and decentral models are very much complementary. Both will be required going forward, same as the day ahead and the intraday markets are complementary. But let me bring in a different dimension here, or an additional dimension in which we see opportunities from an exchange perspective. Now, we've talked a lot about the innovation and new roles within the power market, but what we also see as important going forward is a link between electricity and, let's say, neighboring or related asset classes. For a link between power and gas and even environmental products, that's currently obvious because of the price development that we see in all of these sectors. And it's just important to manage the price risk on all sides here of the position. But going forward, we will also see new markets emerging. That applies, for example, to hydrogen, of course. I mean, we covered that in the previous presentation, but also voluntary carbon markets, which are far bigger than the regulated compliance markets today, and even new asset classes, such as certificates like guarantees of origin for electricity, energy efficiency certificates, and whatever might arise as innovation going forward. So providing access to all of these markets and cross-segment products on a central venue, that's very much the role of an exchange. But we can naturally not give access to every client for all of these markets. Here, usually a market structure emerges where you have intermediaries and large players or large corporates who then service small and medium-sized clients behind. So that's how we see it going forward. And I think we need to look at it from a more holistic perspective in the task of decarbonization. Power, it is successful on its own, and the power market has reached a maturity where it could grow further on its own, but we also need to see it as a part of a bigger energy market system.
Very good. Now then, let's maybe look into the questions which you all brought up in the chat. And I'll probably read them out and then allocate them to one of you, Tobias, Ed, or Alena. So the first question comes in, the power and gas prices are increasing in the last weeks. Is this situation also linked to the question of central and decentral energy markets? Tobias, maybe to you?
Not necessarily. I mean, the market provides transparency here, and I think there are various explanations out there why, in particular, the gas prices are under pressure going upwards, and that is affecting power prices then as well. It just shows the importance of having access to risk management tools, be it on a central or a decentral venue. Typically, a central venue here have the highest pool of liquidity for standardized contracts, may be complemented by additional products on a decentral venue. So I don't really see it linked to central versus decentral in the sense of being driven by that. I'd rather turn it around and saying a complementary offering from decentral and decentral markets is the solution to the challenges that the rising prices and the rising volatility create.
Do you think the pandemic accelerated the growth for private markets?
Did it? Well, I mean, that is an interesting question. I mean, travel went down, more people working at home. I can't really. It's an interesting question. I have to think about it. Actually, it's taking me by surprise, to be honest. Maybe my colleagues can help here.
Any of you, Alena?
I guess, again, a very interesting question to whether it triggers it. You could say that people working from home more and having a lifestyle that has changed will see different dynamics in consumption of where energy is consumed a lot more, maybe on the domestic side than it is in central businesses. But I don't think it's fundamentally changed the markets at the moment. And I think we need to see a year on from the pandemic where the markets go from there and what people's behaviors start to move forward on. I think what we have seen is that coming out of pandemics, a number of countries making bigger commitments to sustainability and to a green future from the pandemic and green growth. And that we've definitely seen coming through in some of the policies and also from corporate commitments at the moment. But I wouldn't say it's changed the energy markets as we see them yet today. Of course, it's had an impact at the moment into some of the prices, but that's not really to do with the central or decentral effects.
Yeah. And another question which picks up the topic you mentioned in your intro when you said there is some parallel development in the crypto market happening. So the question here is decentralized exchanges, DEX like Uniswap, give centralized exchanges, SEX like Coinbase, a good run for their money in DeFi, decentralized finance. Why could this not happen in energy markets as well?
Well, I mean, that's exactly what I said at the beginning. So we see this development there, but you know, this development is very young, you know, and one of the major changes here, you know, is the business model. You know, the centralized exchanges, of course, live from the exchange transaction fee, and the decentralized markets live from the token economics. They usually release a token that can be used for governance purposes and so forth, and that is kind of harvesting the yield from the liquidity provider. So there is a complete new set of business models, but still, you know, the decentralized markets, one of the biggest difficulties right now is how really decentralized are they? Because decentralized markets also don't only have, you know, they provide kind of the biggest degree of freedom in terms of access. You know, there is no entry barrier, but at the same time, it's also the biggest risk because, you know, all the issues around KYC and anti-money laundering are not being considered. And that's why, you know, it's impossible to say, you know, this one will win over the market, because that will never, to my opinion, be accepted in a world where, you know, there is no KYC or anti-money laundering rules prevailing.
Yeah.
So that, yeah.
Yeah. There's another question coming up: how to incorporate grid-related restrictions in current markets, knowing that TSOs are only connecting a minor share of the total renewable capacity installed, Tobias?
I think that That is an area where we will see further innovation going forward. I mean, we see first solutions already with decentral markets on the DSO area, and there are different pilot projects underway. Of course, one prominent one is the Enera project. We have Windnode in eastern Germany. Several of these pilots are also supported by the central exchanges. These decentral markets naturally incorporate grid restrictions into the market, but to me, the answer of how these local pools are then connected to the cross-border day-aheads and intraday markets is not yet completely answered. What's definitely helpful is to have all of these markets on the same technology so that order books can be linked and liquidity can spill over between the different regions. So generally, I think that's the way forward. But which platforms, which technology, and which products then ultimately will provide the best solution to the market demand, I think that's an answer that we will only see in the years to come. And maybe it will be also constant evolution over time.
Yeah. The future market design, of course, also needs flexibility from the demand side. No? So kind of bringing the flexibility of industrial clients, of even of households, if you think about charging of electric vehicles into the overall system design. So what is needed to now make this also happen, regulatory-wise, technologically-wise, to not have an idea only, but also make it practically relevant for the market design?
I mean, some of the biggest drivers, that open up kind of the business models in local markets is the fragmentation of the grid accounting. And we have done a lot of tests with DSOs all over Europe, where we have been testing the new market design, which is open source, and that's there will be no market design if there is no consensus around it. That's why the only way it can be programmed or can be done is open source, and then you create a consensus with a lot of people around it, if that makes sense, And so we did a lot of hackathons with DSOs where they tried algorithms on flexible tariffs actually to manage congestion and so forth. And so as you start opening up, as we've seen in a couple of countries, Spain, Italy, Austria, as you opening up kind of the fragmentation of the grid accounting on low, medium voltage, that opens up new margins, which at the end become a benefit to the final consumer. And the final consumer, as there is aggregators providing kind of those degrees of freedom of local markets to final consumers, and assets can participate in markets, everything that can actually react, every flexibility gets a return on investment curve. And that's a no-brainer, meaning electric vehicles, vehicle to grid and so forth, everything starts to make money or buys cheaper. And meaning invoices are going down or revenues are going up. And that is a no-brainer. And the grid fragmentation is one of the biggest drivers. And at the same time, also the definition of new roles, BRP providers and so forth, and allowing kind of allowing local market operators. There is still a lot of definition needed, and so we are in close cooperation with Florence School of Regulation and other regulators, and discussing exactly about these new roles and how this could be enabled. But Austria already is making a quite strong step that it's not even requiring a BRP at a very small scale, and you can allow local people to trade between each other. So the direction is already going into, so the regulatory direction is already right. We just wish it could happen faster. But there is always like push and pull, so we need to demonstrate more, and the more we can demonstrate, and usually the way we demonstrate is we set bounties to break this model. As long as we can break it, it works.
Yeah, Tobias, if I can put that question also into your direction. I mean, the aggregators, the demand flexibility still play a rather small role to provide liquidity on exchanges, right? So what could be helpful to give this flexibility more visibility on the exchanges, on the markets?
Yeah, first of all, I have to agree again here that the fragmentation on grid level is still hindering further growth here. Actually, the situation is similar to what we've seen 10 to 20 years ago in day-ahead markets. Here, we also had different rules, different products on two sides of the border. We even had different gate closure times, and the fact that we have overcome this situation was a key success factor for the high liquidity growth that we have seen since then. I think the situation on the lower grid levels is similar. So more harmonized regulation here and DSO procedures are definitely one key factor. But then on the other hand, I think that the share of aggregators or companies that could provide the service is not so small, actually. I mean, many clients, many members of the exchange are servicing lots of retail customers, even households, and they can easily bring this liquidity onto the central marketplace, very provided that there is an automated way for measuring the demand, of course.
Okay, thank you very much. Time is up. Alena, Ed, Tobias, it was great to discuss it with you. It was great to have you here today. This will not be the last time we discuss this. Looking forward for further exchange on that topic.